Our guest says that while market sentiment has dropped over the past month, recent strength, so we have seen stocks bouncing from April 8th, is a decent sign for the next 6 to 12 months. We're joined by Ross Mayfield, investment strategist at Baird. Ross, great to see you and happy Friday.
Same to you. Good to see you as well.
Are you in the camp that thinks that Trump's latest tariff warnings are part of this negotiation game?
I wouldn't want to venture too far into the psychology of the administration and why exactly they do the things they do, but you have to assume that it's all part of a negotiation, right? Now, whether the negotiation tactics are worth the business uncertainty is a bigger question. But I think, yes, this is meant to put pressure on trade partners that they view as not negotiating in good faith, and to really ramp up the aggression to try to get these deals done. So I do think it's a negotiation tactic. I'm just not sure whether it's a very good one or not.
And we have seen quite the bounce in markets. I mean, the S&P up something like 17% from the April 8th lows. And is that largely because of de-escalation, for example, Trump postponing some of the biggest tariffs?
Yeah, absolutely. I mean, I think we came into the year with the economy and corporate fundamentals on pretty solid footing. Not a perfect backdrop, but certainly pretty strong. We can see that just peeking through the Q1 earnings reports. I mean, earnings growth was strong. Most companies were doing pretty well. And then since the tariffs have been postponed, and especially since the de-escalation with China that took place a little bit later on, we've seen this huge rally, strong breadth, big momentum, cyclical leadership. So it's really saying to me, the market wants to be in a bull market. And the only thing really holding it back is this uncertainty around trade. And that's just going to persist. So I actually think that the strength in recent weeks should be celebrated, but we need continued improvements on the trade front to really unlock this thing.
And your concern here is that it's just hard for companies to make hiring and investment decisions amid this unpredictability.
Yeah, absolutely. I mean, look, we are in theory in a 90-day pause of reciprocal tariffs, but if we can overnight levy tariffs of a much higher rate on a certain trading partner, even though we're in theory in a 90-day pause, what does that say about the negotiations with other countries, with other companies? It makes it a very uncertain backdrop. It's the reason you're seeing all these companies, pull guidance or punt on full year guidance because they don't know. And if they don't know, they're not going to be willing to take the risks of hiring, a lot of people or, investing in a new factory or a new product launch or something like that. So it doesn't mean that we're necessarily headed towards a recession, but it kind of puts us in this status quo, kind of just waiting. Mm-hmm. And certainly with the uncertainty as high as it is, the incentive for business leaders is to hold pat instead of to take big risks.
We've heard a lot of talk about this move up in U.S. bond yields, a.k.a. selling in the U.S. Treasury market. Although it's interesting, Greg Ip of the Wall Street Journal says, let's put this in perspective. With a 10-year yield at 4.55%, we're still back to where we started the year. And in fact, it's now dropped below that. And we're still down below 5% hit in late 2023. So he argues this is not a titanic change in the markets.
Yeah, I would agree. And I think the big move we've seen, obviously, there's a rush to blame it on the tax bill and the fiscal deficit. I'll give a shout out to our partners at Strategist under the Baird umbrella who have noted that if it were just all about the U.S. deficit, then why are 10 and 30-year bond yields in other countries around the world also going up aggressively? You look at Japan, Germany, all across the world, you're seeing this move higher in long yields. So there's something else at play, probably some combination, it's always hard to suss out of rising inflation expectations that come along with a broader deglobalization, but also the sense that maybe we'll get better economic growth if there's not a full-on trade war. So I don't think that it's necessarily all bad. Certainly at key levels, the equity market starts to revolt a bit, but to us, it's not the biggest hindrance out there to markets.
And you think if people are holding bonds, it could be a good strategy to increase your duration, your term to maturity, which would tend to be a good strategy, obviously, if yields came down.
Yeah, we've been, if you look at just the 10-year, for example, we've been bouncing around in a range from, call it like 350 to 5% for the better part of 2 or 3 years. And so the strategy that would have worked over that period is every time you start to push north of 450 on the 10-year, it's a good time to buy. It's a good time to lock in some yield. It protects you, on the off chance that the economy does slow or we do head towards a recession and yields fall, or the Fed feels like they can actually cut rates and yields fall. You get the price appreciation and you're locking in a real yield, which, we've seen real yields rise over the last couple of years. But if you stretch it back over the last 15 years, the yields today are incredibly attractive versus what anyone could have gotten across the 2010s. So I think for people who own bonds, and particularly for the income portion, going up to the 10 and 30-year treasury or high quality fixed income makes a lot of sense here.
Ross, thank you very much indeed for joining us, and have a great weekend.
You as well. Thanks.
Ross Mayfield, investment strategist at Baird. Coming up, shares